Success in Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You're listening to the Financial Survival Network. It's Kerry, Lutz, and it's time to talk with Danielle Park. It's been a couple of weeks. Danielle, welcome back.
Thanks, Kerry.
So nothing much has changed greatly since last we spoke, except the dollar having a little bit bounce back, but Canadian economy sinking very quickly, Chinese economy sinking very quickly, Australian economy, not a pretty sight. Europe, total mess. U.S. economy, starting to see corporate profits sink as a result of a strong dollar. Profits are down. What's your take? Anything happening here that we haven't discussed before, or is it the situation really starting to accelerate?
I think it's accelerating. Those themes that you touched on there in the opening were all actually directly related. And all of those economies, China, Canada, Australia, New Zealand, basically all have had the greatest consumer debt bubble in the past 4 years, let's say, as QE was driving commodity prices higher, even as global demand turned down, and corporate profits actually have been declining since they peaked in about 2011, even with all the buybacks. If you look at a longer term chart, the trend is down, even with the remarkable buybacks that have, kept them at sort of artificially high levels, even as sales plunge. So these trends have been, in a one sense, it's accelerating and it's picking up now. And you could say that it's all of a sudden happening. On the other hand, in fact, it's been happening for the past 4 years, I would say. And it's just getting harder and harder for, policymakers to paper it over. I think that's the critical thing. With never before has the central bank of the United States come into this kind of a downturn where the U.S. economy is disappointing left and right. And they have not only no rates to cut, but they're trying to, reverse course to a tightening bias. And in fact, in Janet Yellen's, talk last week, she still reiterated that she thought they could be tightening, at any time in the next few meetings. So this is really unprecedented territory in terms of, bubble conditions in asset markets as far as the eye can see. No stimulus of any kind available because it's all been spent. And global demand continuing to plunge. So I think, it's really quite a, if we've had these, a compilation of similar threats or issues at the bubble peak in 2000 in the stock market, at the bubble peak in 2007-8. But I think on pretty much every single metric, you'd have to say that all the conditions are worse now, this third time.
Yeah, definitely worse. And we're not going to have the world's central banks to backstop it, from what you're saying. So it's kind of like a falling knife with nobody jumping in there to catch it.
Yeah, well, as I was writing too, with respect to the price of oil, how there's no quick fixes this time. And so much of the North American economy became concentrated and dependent upon the energy sector in the past few years. That was fueled by, hyper investment out of the credit bubble. That was extended by QE flows that speculated and drove a lot of trading in commodity prices. And those elevated prices attracted, more and more production. And then you got this sort of, unnatural spike in many of the prices. And all of that is really coming back full circle now, because as world demand falls and, output is at its highest ever, and all the negative impacts that are flowing through the economy result of that, you're having at the same time a lot of people hoping for this quick rebound. And my point would be, for example, in oil, that they're saying surely this will just be a quick rebound because they're conditioned by the experience in 2009 where prices plunged, by 2/3, but then quickly rebounded again and spent a few years again in sort of bubble zone. So I think this time there's no cavalry to run in and save these, speculators who have been, overpaying in this commodity market. So it's one of those things where mean reversion will have its way whether you like it or not. It's just being prepared and being, not trying to imagine things the way you would like them, but dealing with reality as it is. Gary Cohn, the president of Goldman Sachs, was interviewed on CNBC, I think it was 2 weeks ago, and he was, he admitted, which is a new development, because most of the time, we know commodity prices have been falling for years, but oil prices have been plunging since last June. And for a long time, the talking heads were ensuring everyone this was all very positive. But Cohn said in his interview, the effects of the soaring dollar are just starting to be felt for U.S. exports, for manufacturing, for jobs, and it's not positive. And I think that is the story. In Canada, we are just blindsided, unfortunately, although many of us have tried to sound the alarm and tell people that this was going to be the case. Many people have just stuck their head in the sand, hoped that it would pass quickly, hoped that oil would rebound fast. And you're just seeing day after day here the capitulation of players who've been trying to hold out, who've been trying to keep their trading operations, and they're starting to close them, who have been laying off, hundreds and hundreds of people week after week to shutter certain operations. They're really running out of cash fast. And that's because they, as I say, were too confident, spending too much, buying back their own shares, issuing a bunch of cheap debt. So they come into this downturn unusually unprepared and vulnerable.
Well, you know what they say, Danielle, hope springs eternal, and it's always easier to hope than to actually do something about it. But this is a theme that you've been voicing for the many years that I know you. There's nothing really different here. But I guess the Greenspan put is kind of been put off, hasn't it?
And even Greenspan was talking, was it last week I saw him being interviewed, and he was the one who said, obviously we're extremely overvalued here in the asset markets, and that's going to be a problem when we come into any kind of a tightening environment. And here's the other thing. Everyone's talking about, this won't be a problem, is the theory, until the U.S. starts tightening. And then when it starts tightening, as long as they do it gradually, it shouldn't be a problem for overvalued assets, except that that's never been the case, right? And the other thing is, it's not necessary for the central banks to increase policy rates to have a monetary tightening. The rebound in the US dollar, which we've touched on in our conversations before, continues. Yes, there's a bit of a weakness over the past couple of days, and I think the algos see any weakness in the US dollar to go long risk assets. So you see a rebound in some aspects of the market, although it fizzled again yesterday, and it's only in certain areas. But oil rebounded a bit this week on a weaker US dollar. But I think that what people are missing here is that this is a long secular rebound that we've been witnessing now from the double bottom in the US dollar that happened in the last 4 years. And as that continues, all this money that's been borrowed in the world in US dollars for the Kerry trade is being repatriated, because the emerging market economies, they're seeing a lot of capital flows tearing out of them. They have to then, when you've borrowed money in US dollar because it was weakening and the trade was making sense for you, now you're getting creamed as the US dollar strengthens. So everybody's in a rush to buy US dollars to pay off whatever debts they can. And that is the put that's under the US dollar right now. So if you think of it, it's this tightening that's happening regardless of whether any central bank wants it. They all want to keep pumping liquidity. The reality is that the greenback strengthening is sucking capital out of investment markets, a lot of speculative markets and assets, and out of other economies, which is just slowing growth everywhere and hitting U.S. profits. So it's kind of this perfect storm 1-2 punch of, impacting everything. The profit cycle, which everyone was so confident would continue, is getting creamed, and the risk trade is losing money by the day, and you're seeing liquidity literally vanish.
And for many of the newbies out there, Danielle, how many of them haven't even lived through a real bear market?
Well, this is interesting you say that, because I was noticing on the Bloomberg this morning as I was getting ready for work that the people that are on that show so often these days are 30 somethings that I've never even seen before. So it strikes me remarkable that every cycle, the sales force grabs their newest, latest wonderkind, who typically has a very handsome face and good teeth and no conscience or historical perspective. And they come in and they start spouting out the sell side nonsense with great confidence. And the irony is that when the poop hits the fan, as it does each cycle, those people leave. They get fired, or they, whatever, they disappear, and they replace them with new faces the next cycle. So there's never any accountability or, continuity or historical wisdom that's espoused by these talking heads.
Yeah, isn't that funny? It's the more things change, the more they stay the same, Danielle. Those guys have been coming and going since I've been around, and probably long before me as well. I wish I could talk to my father or my grandfather and get their take on it, because these guys have always been around, and they've been writing for the Wall Street Journal before television. They were on the radio, touting stocks, hyping the hype, and just giving out their sage wisdom, of which
well,
they
the
have
thing
none.
Is, no, they don't, but we used to call them stock promoters. And here's the real danger that's evolved in the financial system. Since the early 1980s, when they began chipping away at Glass-Steagall, when they began lobbying Congress and governments all over the world to get those Chinese walls removed between, insurance and trust services, advisory services, broker dealers, all this stuff, they used to be separate product types and firms, and you could discern who was the salesperson from who was a fiduciary advisor. And in the last many years, they've taken away all those barriers and they've put them all into one pile. So what's particularly dangerous today is not only that stock promoters are marketed as advisors who have the, quote, best interest of the client, and they're giving them sage advice and all this nonsense, which has never been the case. Not only is that the problem, but they are allowed to basically change all the laws in their favor. So, and also the media is unprecedented. We've never had the concentrated business stations who promote these people like rock stars to an unsuspecting viewer. And I think that those things make it particularly toxic this time. We were talking just before the call about the developments with the SEC fiduciary standard stuff. So Mary Jo White, the head of the SEC, is on the Hill today giving testimony because, as you know, Dodd-Frank talked about developing a common standard of care for people in the advisory, financial advice business. Well, as you know, broker-dealers have had only this very watered-down, weak suitability standard that they have been able to rely on. But advisors traditionally, like lawyers, like doctors, are supposed to be under a fiduciary standard, which means no secret profits, putting the client's best interest first, and, having no conflicts of interest or removing yourself from conflicts of interest. So what you're seeing now, and it's playing out in the press, and it's playing out in the testimony before the government, is that they want to water down that standard. So both Obama has mandated that they come up with this new common standard, but the problem is that the industry is still fully in charge of this whole discussion, and they want to co-opt fiduciary standard, which is a legal principle that came from years of common law and equity about what, how an advisor has to act for the person who's following the advice. And the industry is now wanting to say, fine, we'll go by a fiduciary standard, but it's not going to be, we don't mean a real fiduciary standard. I mean, we are going to still be able to collect commissions. We are going to still be able to have, grades on a grid for incenting sales of certain kinds within our, quote, advisors at a firm. We're not going to have to separate the selling side from the advising side. We're going to still be able to use the advising side as a distribution for the firm's products. So in other words, gutting it and using it as nothing more than a sales jingle, which is, a complete affront to everything that the fiduciary standard was supposed to stand for and has done for hundreds of years of jurisprudence. So this is where, we've really got to step back and and reverse so much of this damaging policy and thinking that's gone. As you say, the people around today haven't seen a bear market. I think so many people in the finance industry have no concept. Well, they're mostly, I guess, not lawyers, but even then, they have no concept of what it means to put the client's best interest first and why you can't be riddled with conflicting interests that pay you more for certain types of advice.
Yeah, and why certain products should pay you a higher commission than others. It's just simple. If you want to collect commissions, if you want to sell certain kinds of products, then style yourself and the firm as a sales organization, not as an advising organization. Say, listen, buyer beware. We're salespeople. We're here to sell products. We make these kind of commissions. I do not have to put your best interest first. Those are the kind of precursor comments or disclaimers or things that need to be up front. It should say financial sales person. It shouldn't say financial advisor. And that's where this whole mushing it up together since the 1980s has caused us such grievous harm. Hey, by the way, you know what they used to call stockbrokers once upon a time before they were called stockbrokers?
Stock promoters?
No, they were called customers men.
See, well, that was a euphemism as well.
Yeah.
That's a euphemism as well. Just call a spade a spade. And then if people choose with their eyes wide open to buy things off of, promoters of different products. And here's the other thing. It's one thing for, someone to have excess capital and go to a hedge fund or somewhere and say, I got $100,000 I'd like to put at risk just to see if I can win something on it, essentially. That's one thing. But this is different. The advising community through the banks and investment dealers pretend to look at a person's entire net worth, and they could theoretically take on the entire savings of their clients. In fact, that's their goal, is to get, they call it share of wallet. So they want to get as much of the client's savings as possible. And then they want to turn around and advise that if they want to increase their portfolio, they should take loans against their house so they can buy more of these quote investments. Yeah, I had a very funny thing happen the other day. Honestly, it cracked me up. So my local bank called to ask about a line of credit that we've had for a number of years, and I just have never used it. And I said, you know what? I'm going to close that because we don't have any interest in keeping it. We don't need it. And the woman says to me without a heartbeat, she says, but with rates so low, why would you not borrow on this line of credit and buy some of these here investments, is what she said to me. This is a lady calling from the bank. Why would you not buy some of these here investments? And I said, oh my, you are barking up the wrong tree, my dear. But thank you for your time. Just close the line of credit. And I got off the phone and I thought, not only does she not know her customer or have any idea who I am, apparently, like she called my office, but it didn't twig. Yeah. But she's literally saying, I've been with the bank for 30 years. And I tell you, now rates are so low. This is a great time to be borrowing and buying some of these here investments, and not even embarrassed, not seeing any conflict in that advice, but that's right. What's happened, and that's why the economies of the world are full of so much debt. That's why the Canadian economy is up to its eyeballs in consumer debt. People have been listening to those types of people and doing things like borrowing against their house to buy these here quote investments.
These here. Well, this here is a real bad situation that we here find ourselves in, and really need to be thinking about why those rates are so low. And one thing, Danielle, what should interest rates really be at? That's the burning question. We're really in a credit bubble bust, and therefore, what happens there is that loan demand for loans is really low. The places where you can get the loans in housing and credit cards, consumer finance, it's really, the fact of the matter is in housing, it's strictly backstopped by the government. You shouldn't really be able to get a mortgage loan, and you wouldn't be able to were it not for Uncle Sam here in the U.S. So what the real price of a mortgage should be in the U.S., I have no idea.
And
I don't think anybody knows.
CMHC in Canada, same thing. They've underwritten 90% of the mortgage market in Canada, which means the government is underwriting the risk. And so the banks can afford to make, to offer loans at lower rates. It's because we don't have a free market in any of these areas right now, it is impossible to say. On the one hand, I can see that the incredible indebtedness in the world, as well as the demographics, the aging population that's wanting to consume and buy less, and certainly doesn't want to have much credit moving into its elder years. That would be one of the massive forces for lower rates all over the world. At the same time, risk is not priced correctly. So many of these issues that should, as you say, if they weren't backed by the government purse, or if they weren't, issued to a yield-starved public pension system, for example, that's supposed to try and clear a hurdle rate of 7% when rates are, under 2%. So they reach for this riskier and riskier debt, and that's been going on worldwide. So because of that, you have an appetite or a willingness to be paid next to nothing for ridiculous risk to capital. So all of those factors are artificial. Those monetary factors are artificial in a sense. I think rates would be low just based on their own organic reasons, but that would be for but whether they'd be as low as they are now for the highest quality credits remains to be seen. I'm not sure about that, but I think that certainly the higher risk credits would not be priced as low as they are now if it was not for all this intervention and artificial, goosing of things. So it's quite a mess. And at some point you have to have some price discovery in order to reset the thing. And that's what we wait for every day, because, no one gets to contrive and contort forever. And they've done a hell of a good job of it this time. There's no question. But at the edges, we see all this evidence of truth getting out, and large market swings, crashes in major commodities. This whole thing with Michael Lewis coming out with his 1 year anniversary of his book, I found it quite depressing, honestly, because here a year ago the whole Flash Boys story comes out, and everyone's talking about HFT and how it's a scandal and it's a rigging and it's an artificial condition for public markets, and yet here we are a year later and basically nothing at all has happened. Oh, well. They're still jostling and talking and wanting to study whether it's in the public's best interest, when anyone with half a wit would know that it's not in the public's best interest. And this whole front-running business and selling order flow, it's an absolute abomination.
And you're surprised about what?
Well, I'm not, except that, here's Warren Buffett has that great saying, you won't know who's swinging naked till the tide goes out. Well, here's what I know about bear markets and market losses. You have a big market clearing decline, and you get all the sales folks coming out with their hands behind their head saying, I surrender. It wasn't us. We didn't know. And that's what's going to happen. The HFTs, they're going to come out and say, we didn't realize we were just doing our own little thing over here, and we were told there was studies done by different organizations who said that it was good for public markets, that we were providing liquidity, but in fact, liquidity like that vanishes in a heartbeat, and that will be the great unraveling of all this, because we already see cash liquidity evaporating out of the system every day as more people go to the sidelines. As I say, as this carry trade gets unwind, as people sell things, margins going down, not up right now for carry. It has been over the past few months. So ultimately, those cycles are all precursors for forced selling that picks up and continues for a period of many months. And that's where you typically get the bottom finally in some of these bubble prices. Absolutely.
Well, on that note, Danielle, we've got to get going. Find Danielle's work, excellent work, commentary, and aggregation of numerous articles at jugglingdynamite.com. And you'll find the link on our site at financialsurvivalnetwork.com. And make sure you sign up for our newsletters and take a look at the sites. You'll like what you see. I guarantee you, information you're just not going to find elsewhere. Beware. Buyer beware, investor beware, because very few people really have your best interest at heart, regardless what they might say, right, Danielle?
Unfortunately, it's true.
Yeah.
But as long as they're honest about it.
Yeah. Well, that's the whole point, isn't it? That's the whole point. They're not honest about it. So anyway, Danielle, we'll see you in a couple of weeks. Thanks so much and be well.
Thanks, Kerry.
The Financial Survival Network. It's all about what's next.
Every week, the show is growing. Would you like to be a part of it? Then go to clubfsn.com and help support us with $1, $2, $5, or $10 a month and get a host of premium content with newsletters dropped into your mailbox, free books, private audio clips, webinars, and much more. Then join clubfsn.com. If you want to get ahead of the trend and ensure your family's financial security before it's too late, go to clubfsn.com and sign up.
FSN Radio. It's all about what's next. FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.